Welcome to this explainer. Okay, I'm going to tell you something right up front that might actually make you a little uncomfortable. If you're keeping your money parked in a standard savings account, you're earning a measly 3.5%, right? Meanwhile, inflation is running hot at 6%. Think about that. You are literally losing wealth every single day. Look, if you aren't investing, it's not because you don't have the money, and it's not because you don't have the time. It's actually because you've been sold a set of lies. And today, well, this explainer is your aggressive wake-up call. We're going to completely dismantle the 5 lies about stock market investing that are keeping you poor. So here are the 5 massive wealth lies keeping middle-class professionals totally paralyzed. 1, you need perfect timing. 2, you'll lose everything. 3, it's just too late to start. 4, you need lakhs of rupees to begin. And 5, taxes eat all your gains. They sound like undeniable facts, but they are completely false. And believing those lies has a massive literal cost. Let's put this into perspective. If you leave 2.5 lakhs in a savings account, you might earn, about 750 rupees a month in interest? But if you had put that exact same 2.5 lakhs into an invested portfolio just 3 years ago, it would have grown to 3.8 lakhs. That is a 1.3 lakh gap in just 3 years. The only thing keeping you on the losing side of this math is believing the lies we just listed. So let's tear them down.
Lie number 1, you need perfect timing to make money in the market. Waiting for a market crash really feels like the smart, safe move. It feels incredibly safe to just wait on the sidelines. But it's actually a huge financial trap. We've all seen those classic what's up forwards, right? Don't buy now, prices are way too high, wait for the dip. The issue here is that hindsight makes timing look incredibly easy. We look back at a chart of the March 2020 crash and think, oh yeah, I would have confidently bought at the bottom. But in reality, during crashes, the news is absolutely terrifying. Nobody is ringing a bell telling you it's the perfect time to buy. Instead, they're screaming at you to get out while you still can.
Let's look at the actual data on this. Here are 2 real strategies over a 10-year period. Person A tries to be clever and time the market, sitting in cash and waiting for crashes to drop in lump sums. Then you have person B, who completely ignores the terrifying news and just blindly invests 10,000 rupees every single month via an SIP. Both end up putting in 12 lakh rupees in total. But look at the result. Person B, the consistent investor, completely crushed the market timer, walking away with 23.2 lakh rupees compared to person A's 18.2 lakh. That is a difference of exactly 5 lakh rupees. 5 lakh rupees. That is the precise amount of money lost over 10 years simply by trying to outsmart the market with perfect timing. Remember, time in the market always beats timing the market. Moving right along. Lie number 2. The stock market is too risky. This is a deeply ingrained fear. It's usually spread by that one uncle at family gatherings who panics during a downturn and sold everything at a massive loss. Now he warns everyone, you're going to lose all your money. And we believe it because the media absolutely thrives on crash headlines. Bloodbath, billions wiped out overnight. It completely warps our perception of risk. But instead of giving in to the panic, let's look at the actual historical rolling returns of the Nifty 50 index since the year 2000 to uncover the real truth. So, the absolutely crucial point here is this number, 0. Out of every single 10-year rolling period since the year 2000 in the Nifty 50, there have been exactly 0 negative periods. Literally none. Every single time someone invested and just held their money in the index for a solid 10 years, they made a positive return. And hey, don't just take my word for it. I actually challenge you to verify this data yourself using AI right now. Go open ChatGPT and ask it this exact question. It'll pull the historical NSE data and prove to you that over a 10+ year horizon, the stock market is absolutely not a casino. It is in fact one of the safest wealth building tools you have access to. All right, let's hit line number 3. It's too late to start. Oh man, this is the ultimate procrastination trap. It's that constant nagging feeling that you've already missed the boom and it's simply too late. I totally missed the boat. But it's actually amazing how absurd this logic becomes when you stretch it out over time. Back in 2015, people looked at the Nifty at 8,000 and swore it was too high. Then, during the 2020 crash recovery at 18,000, they said, nope, wait for a correction. And today, at 25,900, people are saying the exact same thing. And this brilliantly illustrates why waiting is so incredibly destructive to your wealth. Check out these 3 scenarios projecting out to the year 2035,
all doing a simple $10,000 monthly SIP. The person who started in 2015, when the market was supposedly too high at 8K, ends up with a whopping 74 lakh. The person who waited for the 2020 crash, they end up with 52 lakh. And the person who starts in 2024 ends up with 38 lakh. The person from 2015 doesn't win because they magically bought low. They win simply because they've been in the game the longest. This is the absolute truth you need to internalize right now. Your returns are determined by the time invested, not the timing of the investment. Waiting around for a magical market correction is going to cost you infinitely more money in the long run than bad timing ever could. The absolute best time to start was yesterday. The second best time is today. Okay, lie number 4. You need lakhs to start investing. This is such a massive mental block for so many people. You open an app like Grow, you see a minimum investment of 100 rupees, but you immediately close it because you think investing is just for rich people. My tiny amount isn't going to make a dent. And honestly, I understand why this feels incredibly true. In the first few years, compound growth is practically invisible. If you invest 5,000 rupees and it grows to 5,600 in a year, a $600 gain feels kind of pointless, right? It feels like you're running on a treadmill. But let me show you what happens when we zoom out a bit. Visually dismantling this myth is so incredibly satisfying. Look at person A on the left. They start at age 25 with a tiny $5,000 a month SIP. Now, person B waits 10 whole years until they feel they have more money at age 35, and they start investing triple the amount, $15,000 a month. But by age 50, person A ends up with 1.06 crore rupees, while person B only has 75 lakh rupees. Person A invested way less of their own hard-earned money overall, but ended up with 31 lakh rupees more simply by starting that tiny SIP 10 years earlier. And here is the actual secret behind those numbers: the explosive nature of the compounding curve. The first 10 years, that's just you planting seeds. The growth looks entirely flat. But years 15 to 25, that is where 70% of your total wealth is generated, as the curve literally goes vertical. That's exactly why you must start with whatever you have right now, even if it's literally just $1,000 a month. Just get yourself onto that curve. Finally, line number 5. Taxes will eat all your gains. This is the final boss of investing fears, the paralyzing dread of complex tax forms and giving it all back to the government. People hear capital gains and assume it works exactly like their standard 30% income tax slab, so they think, well, even if I do make money, the government is going to take half of it anyway. And yeah, if that were true, investing would seem pretty pointless. But I am very happy to tell you that assumption is completely 100% false. Let's clearly and energetically break down the actual 2026 tax code. If you put your money in a fixed deposit, that interest is fully taxable at your income slab. So if you're a professional in the 30% bracket, you're paying 30% tax on that interest. Ouch. But look at long-term equity. The first 1.25 lakh of your gains every single year is completely tax-free, and anything above that, it's only taxed at 12.5%. Equity is genuinely one of the absolute most tax-efficient places you can legally put your money. Let's really emphasize the math here with a direct comparison. See, you make 2 lakh rupees in profit. If it's from an FD, you are paying over 60,000 rupees in tax and keeping about 1.4 lakh rupees. But if that 2 lakh rupees profit is from the stock market, you pay just 9,375 rupees in tax. You get to keep 1.9 lakh rupees. You're literally keeping 95% of your gains in the stock market scenario. This completely destroys the myth that taxes are going to eat your wealth. As we wrap up this explainer, I really want you to remember this. These 5 lies are so powerful precisely because they feel true. They play right into our natural anxieties. But as we've clearly seen today, data beats feelings every single time. While millions of people are paralyzed by these myths, boring index funds and consistent monthly SIPs have quietly created crores of wealth for regular families who simply chose to ignore the noise and stay invested. So I've got a question for you to end on. Which of these 5 lies has been holding you back the most? I want you to identify it, leave a comment down below to hold yourself accountable, and then I want you to open your investing app right now. Today, take back control of your wealth and start your SIP. The data is completely on your side. You just have to take the first step.